DeFi is at a turning point today. The recent blow-ups of centralized platforms like FTX, Celsius, have demonstrated the resilience of decentralized application. And they represent a huge opportunity for us to convert more and more people to the values and the tech of our industry. In this context, on the other hand, it has attracted regulatory scrutiny and the infamous Gary. Basically, what we need to do as an industry is to prove the value add and avoid the scams that users have faced in this adoption context, like Luna. I think we are not fully equipped to do that because one of our core primitives, the AMMs, is broken. And it's broken due to a phenomenon called impermanent loss. So impermanent loss, or losses in capital faced by liquidity providers on AMMs when the prices of the assets they supply liquidity to start to decorrelate. Before jumping into that, a quick word about myself. I'm Cyrille Pastour. I'm the co-founder of Swap. We are an AMM that strongly reduces impermanent loss, and that has been live for 4 months on Polygon. I want to do 3 things with you today. First, I want to show you why impermanent loss is a huge issue for healthy and wider DeFi adoption. Second, I want to share with you the secrets that I've learned about impermanent loss over the past years and how you can use them to better optimize your farming strategies. Third, I want to show you how we fight impermanent loss at Swap. So first, impermanent loss is an issue for DeFi adoption. The first thing that you need to understand is to put yourself in the shoes of a new DeFi adopter. You're going to use the core products of DeFi, like AMMs and collateralized lending products. And the first thing that you see about DeFi is this weird impermanent loss phenomenon, which is super hard to understand, and you will most likely get wrecked. So I think that is a very bad first contact and first impression with our industry. There are other factors to DeFi adoption linked with impermanent loss, which are much more critical, I think. The first thing is that due to impermanent loss, AMMs are actually not profitable for liquidity providers. And in this aspect, we had some really interesting recent studies that came out of crypto Twitter. So some people have basically redesigned from the ground the PNL of LPs on Uniswap v3. And what they showed is that the product is not profitable as a whole. So basically, the losses of liquidity providers are, in terms of impermanent loss, represent more than $200 million on the ETH, USDC pool, which is the biggest. And in terms of expected return, it's around minus 0.8% for the 5 bips pool and minus 0.6% for the 30 bips pool. So a negative expected return, which makes me say that AMMs actually are not investment products. They are casino products. Why is that? In finance, when you take more risk for a given strategy, you're expected to perform better expected returns, better returns on average. If we see how this applies to DeFi, we see that collateralized lending products, for instance, like ABR Compound, have very low risk in terms of volatility of their net daily returns, but also very low returns. So it applies to them. Uncollateralized lending at the other end of the spectrum also share those elements, high risk, high return. AMMs, on the other end, have negative expected returns, minus 0.7%, but super high volatility, even higher than uncollateralized lending. When you think about it, a liquidity provider on an AMM has significant chances to make a lot of money, but even higher chances to lose a lot of money, which is not very different from the roulette casino game when you think about it. So what I want to say as well is that actually impermanent loss is an issue for traders as well, for trading adoption. Why? Because when you think about the price of at an AMM, it's basically composed of 2 elements. The first one is the price impact, and the second one is the trading fees. So basically, the trading fees need to be high in order to compensate LPs for the impermanent loss they undergo. So as we saw in the previous example, the 0.3% pool actually performs better than the 0.05% pool in terms of trading fees. So what it means is that essentially you need high fees in order to protect LPs. The other thing is that because AMMs are not a profitable investment product, basically, a lot of people don't provide liquidity into AMMs. And I guess a lot of you today don't provide liquidity into AMMs precisely because you have found that out. So traders face huge price impacts. And today, the trading volume on decentralized exchanges represents only 10% of the total crypto trading volume. So that's still very low in terms of adoption. And I think we need better products in order to make adoption happen. So one other element which you need to take into account is that 70% of the trading volume on DEXs is arbitrage. So basically, it will not have happened on centralized exchanges. So we only have 3%, if I extrapolate things, which is 3% of the total crypto volume, which is on DEXs. So it's very low. So let's get to know maybe better our enemy after showing why impermanent loss is critical, is key to DeFi adoption. So how does impermanent loss actually happen? Essentially, AMMs implement a rebalancing strategy. What they do is that when the prices of the market vary, they will sell the assets that's increasing in terms of prices and reduce their quantity. So they are always short the asset that performs best. So that's what actually creates impermanent loss, is that you always lower exposure to the asset that performs best and increase your stack of the asset that performs bad. How concretely does that happen, and does that translate in terms of portfolio for you? So it's pretty staggering. Basically, during large market movements, which happen both in bull and bear markets, a lot of value is extracted due to impermanent loss. Sorry. So basically, when the price of ETH doubles, for instance, you lose approximately 5.7% of your portfolio. And this compounds further. Like when the price of ETH quadruples, you lose 20% of your portfolio. And when you see a large movement, like what happened during the 2020-2021 bull run, a 30x increase in the price, you lose 65% of your portfolio, which means that you need a 300% APY in order to compensate the fees that you lost, the impermanent loss that you lost. You may think that you're going to be hedged if the price of ETH goes down, but actually it's the opposite. So basically, the same thing happens when the price of ETH goes down, because in this case, the performing asset is DAI and not ETH. So the same phenomenon applies, and in any type of movement, you are losing. So what can you do? I think the best solution would probably not to provide liquidity to AMMs, but you will have to make compromises. So for instance, if you provide liquidity on Aave, you're on a very different risk profile, right? Very low risk, very low return. You can provide liquidity to stablecoin AMMs because they don't suffer from impermanent loss. However, the big problem is that you don't get market exposure. You're not exposed to ETH, for instance, while we are, I guess, all bullish on the future of those tokens. Other solutions include spending a lot of time and having to be an expert to really try to time your position. The problem is that there is no guarantee that you will manage to generate outperformance. So if you have low duration positions on UniV3, for instance, it's very hard to generate overperformance. Other solutions include concentrated liquidity managers. So a very famous example is Arrakis, which is the main solution on the market. What's interesting to see is that Arrakis does not market itself as a yield solution. They market themselves as a solution which is designed to reduce the cost of liquidity for DAOs. They don't even generate revenues on top of liquidity, reduce the cost. So they are not here to generate performance. They're here to help DAOs better manage their liquidity so that people can trade their tokens. The last thing that you can do is to use insurance or hedging products. There is a big issue with insurance, is that it's always better to solve a problem than to insure against it. Imagine you have a house, and basically you don't want people to steal your stuff. Well, there are two options. The first option is to just close your door, close your windows, lock them, and go out, and nobody will steal your stuff. The second option, which is the one promoted kind of by bank or open, is to leave your door and windows open and subscribe to home insurance. Both solve the problem, but one is much more costly than the other. So that's why we came out with Swap. So basically at Swap, what we are doing is that we want to build passive, profitable, and secure yield strategies for any type of LP. And we do that through market making. We have two main principles. The first one, integrate information and math. The second one, reduce toxic flow. So basically, when you look at the history of finance, finance, generating performance in finance, in financial markets, has always been about having more information than others or having better, smarter algorithm. I don't think that this is going to change with DeFi. So regarding the information point, basically, hedge funds in TradFi buy satellite data in order to anticipate the production figures of oil. In DeFi, AMMs don't integrate any information at all and think they can generate overperformance. I don't think that's sustainable. At Swap, we use frequent Oracle updates in order to get our quotes. Math, then. So the funds that have demonstrated the best performance over the last 40 years in TradFi are funds which have focused on hiring the best PhDs in physics and math. And they rely on complex algorithmic strategies. In DeFi, AMMs use X time Y equals K formula to price their assets and expect to generate alpha. Again, I don't think this is possible. So at Swap, what we do is that we use stochastic calculation-based model in order to evaluate the fees that we're going to charge to our traders. Second, reduce toxic flow. So in an AMM, actually, you don't have two types of users, you have three types of users. You have the liquidity providers, you have the traders that actually want to trade, and I think this is very important, and that are willing to pay a commission to swap an asset against another. And then you have the arbitrageurs. Arbitrageurs are just here because they want to extract value. They perform only EV plus transactions. So basically, the money that they extract has to be taken from somewhere. And the somewhere is the liquidity providers. So by reducing the arbitrage flow, we're able to increase value for liquidity providers and indirectly for traders who don't have to pay the cost of arbitrageurs trading. So how does that happen concretely? So the strategy that we have implemented is a hodl-like strategy. Essentially, what we do is that we don't rebalance the quantities of assets that are in our pools. So what I mean by that is that imagine you have a pool with 10 ETH and 10,000 DAI, and the price of ETH is 1,000 DAI. If the price of ETH moves to 2,000 DAI, what will happen in a traditional AMM, as we saw earlier, is that it will be rebalanced to 7 ETH and 14,000 DAI. What we do at Swap, and this is what will generate impermanent loss, because you reduce exposure to ETH, which is the good asset in this example. So what we do at Swap is that we try to maintain the same quantities of assets, so 10 ETH and 10,000 DAI, no matter the evolution of the ETH price. This creates two problems. The first one is how do you quote a price? Because in traditional AMM, prices are quoted by the balance of the quantities of the assets. The second problem is how do you maintain this equilibrium? Because if someone trades with this pool, essentially what they're going to do is that they're going, for instance, to buy 1 ETH. So the pool now has 9 ETH and 11,000 DAI. So in order to solve these two problems, we have first implemented oracles, as I said, frequent oracles, that allow us to get a price. Oracles they also allow us to reduce strongly the arbitrage, by the way, which is something we're focused on. The oracles create another problem, which is called front running. So essentially, the MEV traders are able to see the oracle updates in the mempool when they are published, and they are going to be able to profit from that. So in order to counter the front running, what we do is that we run stochastic-based calculation models, all fully on-chain, that are here to help us estimate the probability that an oracle update is going to deviate strongly from the last one in the coming minutes. What that means essentially is that we are trying to predict the volatility of our assets. So basically, front-running opportunities cost more money when the oracle price strongly deviates from the previous update. When the deviation is much smaller, the front-running opportunity is much smaller as well. So we increase our fees when the front-running opportunity is large, so when the price deviates strongly, and we decrease our fees to be more competitive when the deviation is expected to be low. Then we have the inventory issue. So basically, in order to ensure that our pool are stable in terms of inventory, we implement a slippage mechanism. So imagine you have 10 ETH and 10,000 USDC. This is the target balance of the pool. If a trader starts to trade with the pool, this trader is going to basically imbalance the pool. So we're going to charge that person a slippage. This slippage will then be used to help the next trader rebalance the pool, essentially. So now that the pool is imbalanced, someone that performs a trade in the other direction will benefit from a premium, a kind of arbitrage opportunity, in a sense. So far, the performances of our product have been very interesting. So over the last 30 days, our net yield, so we have a pool with USDC, BTC, ETH that has been live on Polygon for 4 months. The net yield over the past 30 days has been of 5.9%. This is excluding any type of token incentives, and 2.5% since the inception of the product. What is very interesting is that in terms of volatility of net daily returns, the product is actually closer to collateralized lending products than to AMMs, in the sense that the standard deviation of the net daily returns of the product, since we've been integrated with 1inch, has been 10 times lower than traditional AMMs, and only 2 times higher than Aave or Compound. All of this with a product that's very capital efficient for the small trades. So basically, right now, our liquidity is still pretty low, so we're only competing with the large players on the small trades on 1inch. But we saw that basically we were 7 times more capital efficient than UniV3 5 bips USDC ETH for trades below $100. So basically what that means is that swap is a low risk, low return market making strategy, but it's actually an investment product. So maybe to step back, I would like to end on why we need to solve impermanent loss for DeFi and recap around that. I think that it would really help the whole ecosystem benefit from distributing profitable market making strategies for everyone. Would mean that everybody would be more ready to provide liquidity, would mean increased liquidity for DeFi, and also reduce trading fees, so better trading volumes on chain. I think it's also very interesting for DAOs and for like B2B use cases, as for instance, DAOs would be able to earn yield on top of their interest. So thank you very much for your attention. I hope I didn't make you sleepy. Yeah, don't hesitate if you have any questions.
So I have a couple of questions. Like very first slide where you showed analysis and the loss of a liquidity, sorry, of impermanent loss. What's the time frame actually was used for this analysis? Do you know?
So it's a year-to-date time frame. Okay. So basically, it's someone working with the Uniswap team who actually redesigned the Uniswap v3 LP's P&L, realized P&L, since the beginning of the year. So it's like each actual position has been analyzed and integrated.
Okay. Awesome. Another question. You said what 10% of total volume is traded on DEX and 7% of that is arbitrage opportunities. So where's that data coming from? Like, is it analysis done or?
Yeah. So to be honest, on that I don't have like the exact time frame. I think I computed the analysis maybe a few months ago. Okay. So we would definitely need to update that. Regarding the 70% arbitrage volume, it actually comes from a report that has been published by Alastair, which is like a consulting company for the analysis of whether the fee switch should be implemented on UniV3. You can find that report on the DAO governance forum of Uniswap.
And the last question on a yield, it's 5.9 APY, right?
Yeah.
Okay. All right, thank you.
Thank you.
Hi, thanks for the talk. I was wondering, you touched on the topic of toxic flow. I was wondering if you could just briefly explain the importance of toxic flow versus non-toxic flow for AMMs, as opposed to the importance for just traditional CLOB order book, CLOB markets.
So just to understand, like, what do you have in mind exactly?
The reason for my question is yesterday I was listening to a podcast from Doug Colkit, the founder of CrocSwap, and he was just mentioning that FTX had most of the volume came from toxic flow because there was very, very, very low retail interest. So I was just, he touched on this topic for FTX, which is a central limit order book based exchange, or used to be, I guess. But since you touched on the topic of toxic flow, I was just wondering if there are any differences when it comes to toxic flow and non-toxic flow for AMMs versus a traditional exchange like FTX.
So, I mean, I think that basically in AMMs, I mean, traditional AMMs at least, I'm not talking about swap here, but toxic flow is the way you get the price information, essentially. Basically, it comes down to essentially paying arbitrageurs to know what the price is, where the price discovery happens, which unfortunately is not on-chain today. It's on Binance, basically. So I think that in traditional AMMs, the toxic flow is like the one of the design mechanism, essentially. And I think this is a problem because in any case, toxic flow is bad. Like, it hurts you as an LP. Like, the value is really extracted from you, and you shouldn't want to like. What makes profits in market making is actual people that want to trade. It's not people that want to extract value.
Thank you.
Thank you.
Thanks for the talk. I just wanted to ask about the over here. Seems to be there's a dependency on the Oracle to update the price frequently. I just wanted to ask about the security mechanisms you guys have in place to protect from rogue Oracle or big price changes.
That's a very good question, and of course that's one of the drawbacks of the model. So basically, what we do is that first the biggest attack vector is a manipulation of the Oracle price, or So one example of that, for instance, were the attacks that have been performed on GMX and Mongo markets, where someone changed the price on a centralized exchange and then used that to trade on those products. So first, at Swap, we have a slippage mechanism. So the price is increasing strongly when people try to deviate too much the pool from its target balance. Second, we have a 2% hard trading frontier. Essentially, if the pool is imbalanced by more than 2% of its target inventory, it will not allow people to trade anymore. Like, we just stop trading because it's too risky in terms of inventory management. And the last thing is that we have mechanisms to ensure that the Oracle information are properly streamed. So if we see that the Oracle updates too slowly, for instance, we'll just cut the trading. It's going to be posted, like it's embedded into the smart contract logic. So on Polygon, for instance, the oracles are streamed like every 27 seconds. So if we see that we have a timeout which is too infrequent, we just pause the trading.
Awesome. I was going to ask, after seeing this presentation, I guess my main question is, why do you think people still provide liquidity if EV is essentially negative and I'm exposed to huge volatility? Like, are you essentially claiming they're uninformed?
I think there are two elements. First one, it's PvP. Essentially, why do people go to the casino? Because you have the possibility to win. And if you win big. And people like that. And also, this is based on skill, right? So like Uniswap v3, I think this is one of the biggest innovation of Uniswap v3 is that it's like poker, in fact. It's not like roulette, it's like poker. Or blackjack. Like you're playing with others based on your skill, or you think that your skills can influence the game. And the second one is also, I think that AMMs are still a very interesting primitive for some use cases. Like for tokens that don't have the ability to be listed on a centralized exchange, this is very good because it makes the token liquid and it allows you to have a working community. So I think DAOs are subsidizing actually the liquidity, and I think this is good. But I think AMMs should not be considered as the design that we need to scale the financial system. I think they are the perfect product for long-tail tokens, but I don't think they should be the main trading venue for high cap tokens, essentially.
I have a question. If the trade goes like DAI, ETH, and the ETH goes down a lot, you were saying like you have a slippage to compensate the other side, but if it goes like crazy a lot, like you're going to compensate this crazy amount on the other side to rebalance the pool, or what's the mechanism there?
So actually, it's going to actually it's going to be like the so if it goes too fast, we're going to lose money. Like that's one of the risks of the product for sure, because the oracle cannot follow. On the other hand, like the slippage is paid by the trader that imbalances the pool. So it's a neutral mechanism. So if the pool is very imbalanced, there will be a lot of slippage to compensate on the other end. The big risk is that the oracle updates in the meantime when we are imbalanced, and then it's not profitable anymore to rebalance. So that's the main risk essentially. Thank you very much for your attention.